Okay, three notes for the applied level before we head in. Number one, understanding Bitcoin mining. This video will be up in about 1 or 2 weeks. I've got all my notes done. I just have to do my screens. I'll be using Riot and Mara. We'll be using their 10Qs and parts of their 10K to discuss their business models. And a big part of this video will be contrasting the economics of gold mining with the economics of Bitcoin mining. And just to give you a quick look ahead, if the price of gold dropped to $1,000 an ounce, supply would pretty much go to zero, because there are very few mines that have an AISC of $1,000. So they would simply just disappear. If Bitcoin dropped from 100,000 down to $100, nothing would change. Nothing at all. The supply would not change one bit. There is nothing in that algorithm that dictates what the price of Bitcoin could, should, or would be. It operates at all prices. So the only thing really keeping it up is just consensus, whereas the price of gold is really based on the cost of production. To see this, when you draw a marginal cost curve for gold and you draw the price, you have to turn it upside down to get the understanding for Bitcoin. Number two, for the positions videos for December 20th, if you haven't seen them yet, I do have positions on MicroStrategy, IBIT, Riot, BitDeer, Galaxy, and Mara. Some of these are benchmarked. Well, I'd say most of these are benchmarked. One of them is directional, so you may want to check that out. And point number three, January 15th, the applied level splits into two. Currently it is 440 US. If you have any CFA standing, it is 320 US. It is going to split into two to line up with how CFA prepares you for a career. It either prepares you to be a financial analyst or an asset manager. So the applied level will split along those two lines. For analysis, sector studies and financial modeling will be in there. For asset management, applied options, portfolio construction, and positions will be there. The understanding Bitcoin mining, that is part of sector studies. This is in the software sector. When I looked at the GICS codes, I was surprised to find out that they are in software. Interesting there, right? The price also changes. Instead of 440, it will be 850 for if you're adding both, 425 on each one. If you have a CFA, FRM, or CAIA status, any of these, you get $100 off of each one. So that would drop it to $650 instead of $850. And if you are an MM.com subscriber, whether through CFA or FRM, if you're a subscriber already to any of the CFA or FRM programs, you get another $50 off per section. That brings you down to $550. This begins January 15th. The old pricing ends January 14th. Let's head in. Let's start with the Fed meeting last week, the SEP and PCE, because it was nothing but good news in PCE and it seemed to be nothing but bad news in the SEP. The market did not like it at all, and a lot of things went on sale. So let's look at what happened. This is SEP summary of economic projections. Change in real GDP. This is their forecast, and this was the September projection. Look for 2024. They're increasing their forecast and increasing it slightly for 2025. 2026 the same, but then I don't know how you get that 1.9. Oh, we think in 2027 it'll come in at 1.9, not 2. That's just pure fantasy. Whenever you start projecting things out like this, you might have, based on any company or the economy, visibility in the next week or the next month. But when you're going out 3 years and you're forecasting 1.9 instead of 2, that's pure fantasy. That is just pure fantasy. But they are forecasting stronger real GDP. And as long as you have deficits, government deficits, you can forecast that. The unemployment rate, they're forecasting it lower for 2024 than they did in September, lower for 2025, and then pretty much the same thereafter. Inflation, this is, and the core inflation, this is what really hurt. Is they're forecasting it higher, 2.3 to 2.4 for 2025. That is a big jump up, 2.1 to 2.5. In fact, look at what's going on between 24 and 25. They're actually forecasting it upwards. I'm sure in here they are considering tariffs. So their base case would probably be tariffs, which I think is probably right. To think that China would escape without any tariffs, I think is foolish thinking. So that I think is a given. Trump has pretty much threatened to put a tariff on any country that starts with any letter of the alphabet. Is he going to do it? Is he not going to do it? That's the thing. He thinks it's on brand to keep people guessing, to be uncertain. But markets don't like uncertainty. Asset prices don't like uncertainty. And the wealth of many Americans is tied to asset prices. So he is being uncertain with the very core of Americans' wealth. Markets and people don't like that. So if I had to guess, I would say there's going to be some tariffs on Canada and Mexico. I don't think that Canada and Mexico are going to escape this one. And I think that those tariffs on Canada will lead more to the second P, because Trump has two Ps, right? He has policy and he has punishment. He does not like Trudeau. He doesn't like Trudeau. Trudeau didn't bow deeply enough. Trudeau didn't keep his mouth shut. Trudeau criticized the U.S. What you got to do is you got to bend the knee. You got to bow very deeply, and it's not enough to be silent. You must openly praise him after, and then you can pretty much get what you want out of this guy. But I would say that Canada should expect some pain from this. Mexico, that's a wild card, because they seem to be willing to work, and I think they have a lot more work that they can do, and they don't have Trudeau. So, I don't know. But they're probably, that's what's in that 2.5. Then it drops to 2.1. Core, 2.8, dropping to 2.5. And then the federal funds rate, we were expecting at the end of 25, 3.4, and no 3.9. That's two rate cuts out of the equation. I'll have more to say about that a little later on. But that started the sell-off, and I think the market is still a little wobbly on that one. With looking at the price of Bitcoin over the weekend, because that's the only thing we can look at. The reason I look at it over the weekend is because it is highly correlated. If you do a correlation with Bitcoin and the NASDAQ, they are highly correlated, meaning it is a risk asset. So it is a good sort of indicator over the weekend how the market is feeling. And it is negative as I do this now, and it's been negative all weekend. So I think the market is still a little wobbly. Let's look at PCE, because the market threw a relief party on Friday over PCE, which faded in the last hour a little bit, but it was still a very good day. Let's look at the bottom chart down here. This is April all the way through November. The top line is PCE headline 0.1. See if I can get my pen to work on the chart. 0.1. Look at goods. 0. Durable goods, 0. Non-durable goods, 0. No problem coming from goods. And you had a period here of deflation. That's actual prices going down. That it would find some bottom. Like, it's not doing this. It's done this. That's the 0, right? That seems to make sense to me. Services, 0.2. Let's look at some of the sub-indices. The core, PCE, excluding food and energy, 0.1. Market-based PCE. Market-based means it's going to exclude any imputed prices, and it's only going to look at things for which there is actually a market price for. Market-based PCE, 0.1. And market-based PCE, excluding food and energy, 0.1. I took the index itself and annualized it. The headline PCE for November annualized is 1.55%. October's was 2.78. For goods, annualized 0.516. October was negative 0.7. Services 2.02. The month before was 4.43. So those are big drops down. The big drop here was in services. Core PCE annualized 1.39% from November, down from 3.2 annualized in November. And the market-based PCEs 1.62, 1.44. Looks like you're there. And the Fed is looking at this number right here, headline, which I found surprising. I thought they were looking at core, but during the press conference on Wednesday, he said, consumers are paying for food and energy, so our target is the headline number, which to me strikes me as odd that you'd use the headline as your target instead of the core, because food and energy can fluctuate for all sorts of reasons that have nothing to do with the economy, and that interest rates would never solve, or the money supply would never solve. But that's what he says. Well, 1.55. Nothing wrong with that. Core 1.39. So PCE is sort of pointing to, I wouldn't say job done, but it's moving well in the right direction over October. All right, let's look at the effect of all that on rates and yields. Let's start with money market rates. Last week, the anticipation was for 25 basis points. The market had priced it in, so week over week, almost nothing happening in money market rates. Capital market yields all increased week over week. Had I done this on Thursday instead of Friday, it would have been even worse. Friday there was good news on PCE and a bit of a relief rally, but still not enough to save the week. Ended up with yields even higher. So looking at the chart over here, you had a bearish move. Was it a bear steepener? Let's go over and look at our slopes. All of them, except for one here, all of them increased, except, call it two. So that is a steepening of the curve. So we did have a bear steepener week over week. But look now, all the curves, the 2 to the 10, the 5 to the 10, 2 to the 20, 10 to the 30, the 3 to the 5, the 3 to the 10, all of them upward sloping. In Canada, the 2 to the 10 upward by 23 basis points, the 3-month to the 10-year upward sloping by 12.8 basis points. Looking at real yields, 5, 7, 10, 20, and 30, upward sloping as well. 5-year, all the real yields over 2%. That is very tight monetary policy. Even though you're lowering money market rates, you're raising capital market rates, all your real yields, so much happens off the capital market, not off the money market, but a lot of allocation of capital for corporations, especially over longer periods of time, and a lot of financing decisions by individuals happen off the capital market curve, and you have real yields over 2%. So since the Fed has started cutting rates, monetary policy, where it matters, has actually gotten tighter. January 29th, FOMC, 38 days away. At that point, we will have seen, what is that, the 21st is inauguration. Half a day of work, on the 21st. So you will have seen, call it to the 28th, six and a half days of policy with promises to do almost everything on day one. How many things was he going to do on day one? I lost count. On day one, I'm going to do this. On day one, I'm going to do that. So we'll see what happens on day one. You have 6.5 days to do day one work. The Fed will have some visibility on, how serious all of these things are going to end up being, especially the tariffs. Minutes from December 18th, you get in 17 days. The probabilities as of right now for no rate cut is 91.4. I can't disagree with that. Last week it was 81.5, 91.4. I don't know why you would go in January. This December cut looked like a tight one. I think you'd have a hard time selling a November cut unless you get a January jobs report. The January jobs report's for December. You get it's just reported in January. That's why I'm calling it the January report. You get a very light jobs report, and then you get a CPI that suggested that November was an anomaly and that it falls more in line with what the November PCE was, which was job done. So if you get a really soft CPI and really soft jobs number, and in the first 6.5 days, it doesn't look like Trump is going to put tariffs on Mexico or Canada. Maybe he comes out and says, okay, they're doing what they say they're going to be doing. This is a good thing, but we got work to do. You're never clear with that guy. You might slip one back in, but I seem to think that it would be wise to hold in January. Mexico CPI Monday morning, Canadian GDP for October Monday morning, durable goods for the U.S., and this is for the month of November, Tuesday. Let's look at reverse repo, 98 billion, heading towards zero. I don't think it'll hit zero this month because you have three effects happening: the end of month, the end of quarter, end of year. And money market funds always increase into the end of the year, and then they come right back down. That's just for window dressing. 98 billion, the lowest since this cycle began. Reserves 3.2 trillion, so 835 billion above an ample level. 40 billion a month, 21 months. I expect by July, August, this will all be over. There'll be no more runoff, which will give an extra bit of buying pressure at the longer end. Well, I wouldn't say the 30-year, probably more in here. Give some buying pressure in here because runoff will be reinvested instead of allowed to just run off. We have a new effective federal funds rate, 4.33. Here is the futures curve. It's starting to flatten out, implying almost nothing going on for the year. There's 95.7 over in, let's see if my pen works here, 95.7 here, and you got 96. It's talking about 30 basis points, right? Implied for the next 4 quarters for all of 2025 is 38 basis points. Not even 2. The Fed is saying 3.9 by the end of 2025, that's the effective federal funds rate, which would put the range 3.75 to 4. So that would imply that you have 2 rate cuts, but the futures curve has got 38 priced in. In other words, 1.5 cuts in 8 meetings. I think that's wrong. A long ZQ on January 26. Doesn't seem like it has a lot of downside to me. I think it's more 1 cut per quarter. I think you'll get 4 rate cuts just with the trajectory of the economy. I mean, that's not taking any crisis into consideration that things just fall apart very quickly in the U.S. and you got to cut rates a lot faster. That's just sort of on the path that we're on. I think 100 makes a lot more sense. So there is a gain to be had in a long ZQ with very little downside. The downside is you're wrong on the 1.5 cuts out of 8 is too aggressive. That would be the wrong trade then if you think 1.5 is too aggressive. If you think no, there'll be no rate cuts, even rate increases. I find that hard to take simply because we'll end this week with a deeper look into housing. I was asked last week if I could review the housing market because we've left it for a while, and with Lennar's earnings it seems to make sense to look at it because of what they said. I'll have more to say about that shortly, but I think based on that and the message, it would be hard to increase rates. Okay, for beta, not many updates here on the data. LSEG, no update. So I'm going to use the last number they had, 263.39. We have a lower SPX, 59.30, so only 22.5. After that ugly week, we are down to slightly above nosebleed valuations, 22.5 down from 22.97. with the return of some volatility, 63rd percentile in, if we're looking at a 13-week for SPY 55th for TLT, so some return to volatility. However, when you look at the premiums, they're still not that great. So I didn't do anything on either one of these two because I didn't like any of the premiums. I thought for TLT at 88, when I saw it at 88, I thought, well, here's a great opportunity to do the 85s, 84s, 83s. But the dollar premium for the capital required was, why would I take that risk for this small dollars? Even the in-the-money ones doing a 90, none of it was exciting. So I didn't do anything. What do we got? Look at this. We had a downside gap on SPY. That downside gap is now filled. For the technical analysts looking at this chart saying, hey, we got a downside gap, we're going to have to go back and fix that. All done. So there's nothing holding that down now. All-time high, 607.37, December 6th. Sitting at $592.12, $15 below the all-time high. IWM and IJR, these had bad weeks. All-time high on IWM, 242.56, ended 221.92, down 4.78% week over week. IJR, 115.83, down 5.7. This is curious. I would have expected it to be the other way around. IJR are profitable small caps. IWM is a mix with about 40% of them unprofitable. But they didn't fall as much as the profitable ones. That's curious. No earnings coming up for the next couple weeks. We have Christmas, so nothing coming up this week. We have a very shortened week, and then the week after is the week between Christmas and New Year's. Nothing happening there as well, and I don't think there's much happening in the first week back. So I think we got a 3-week break from this for a while. Trading is short this week, 3.5 days. Monday is a normal day, 9:30 to 4. Tuesday, we all get out of here at 1 o'clock. Wednesday, there is nothing going on. And Thursday, Friday are 9:30 to 4. Volume is usually really light in the Christmas week, the week where Christmas lands. Volume is usually really light. It's usually really boring. Even between Christmas and New Year's, it's typically really light, really boring. The market tends to drift in the direction that got it there. So we did have this sell-off. We may drift down or we may drift up, but usually, as far as back as I can remember, there's very little volatility in the direction that you move. It sort of just drifts slowly and quietly into a particular direction, but big wild moves are gone. At least as far as I can remember. That doesn't mean it can't happen or it hasn't, here or there, but I don't remember it being that these are periods where you have to pay attention every minute of the day. But who the hell knows? Who knows, right? If I had to play the probabilities, I would say if I turned my computer off for 2 weeks, I think I'd be okay. It would, I don't think I'd miss any really big things going on. Looking at implied volatility loss in SPY, 14.5. Last week was 10.2. The week before was under 10. So 14.5, that's a little bit more realistic. And it is above TLT at this point at 14.4. Last week was 13.2. That's a little bit more realistic. Put call open interest, 1.99, 2 puts for every 1 call roughly, and for TLT was 0.9 dropped to 0.69, which makes sense. I mean, you have TLT dropping, it's how much more are you betting on, right? It seemed that the weight of the bets would be more on calls than puts after a drop down. Okay, let's spend some time with U.S. home builders, because they have taken a beating over the last little while. We'll just start at the bottom of the screen here, DHI, and this is from the 2024 highs, whatever their closing high was, where they are now. So Friday, as of Friday closing, DHI is down 28%, off its high. Lennar 27%, Toll Brothers 25%, Pulte almost 26%, KB Homes 26%, Hovnanian 43%. The XHB is down 15.71, ITB down 18.95. All of these in bear market territory. These are somewhere between correction and bear market. ITB getting near a bear market on that price. Looking at a couple of high-level indicators for the housing market, we have the Mortgage Market Index and the NAHB Housing Market Index. This is home builder sentiment. Mortgage Market Index, super low. You can see over here how low it's been from the previous last 2 decades. You got to go back to 1997 to get readings that are that low. Had a nice run up here into August. This is when mortgage rates dropped close to 6%. You had 6.0, I think at one point 6.05% on a low. And this was anticipation of rate cuts. The Fed signaling that the job seems to be done and let's start with rate cuts. And then you had rate cuts start and mortgage rates just increased because mortgage rates are tied to the 10-year. We'll talk about what happened to the 10-year over here. And then since the election, you've had some kind of rebound, but we got close to 7% here, very close to 7%. So 100 basis points of movement. That brought the index 190, call it 290, down 100 basis points. So that's where we are if we want mortgage activity to pick up, and mortgage activity is a clear indicator of housing sales activity, because you don't get a mortgage unless you bought a house, right? Look at the changes here. The 30-year FRM. I'm going back to the day of the meeting, September 18th, because whatever happens on that day, whatever announcement they make, takes effect the very next day. So this is the day before the rate increase. It's the announcement, but the rate decrease doesn't really take effect till the next day. The 30-year FRM was at 6.09, and as of December 20th, it's 6.72, an increase of 63 basis points. The 10-year was at 3.7%, finished at 4.2, an increase of 82 basis points, while over that period of time, the Fed funds rate has dropped 100 basis points, completely in the opposite direction. Mortgages are tied to the 10-year, so mortgages got more expensive. Financial conditions in the housing market got more restrictive. Powell had said way back in September, we are very restrictive, and even at the last press conference, he believed that we are less restrictive than we used to be, but still restrictive. Well, if you were very restrictive in September, and you are up 82 basis points on the 10-year, which mortgages are tied to, you must be extremely restrictive now. Sort of the opposite effect. If we look at the 5-year, just as an aside, this is what auto loans are tied to. Went from 347 to 437, an increase of 90 basis points. So auto loan financing became even more restrictive. As I said on the earlier screen, a lot of financing and a lot of investment plans from businesses are tied to capital market rates, not money market rates. So since the first cut, 100 basis points ago, capital market financing, or financing based on capital market yields, has gotten even more restrictive, which sort of suggests to me that the Fed can continue to cut the effective federal funds rate if you have this effect going on the long end of the curve. The market is making financing conditions more restrictive as the Fed is cutting. Let's look at some of the things Lennar said. I've broken them up between this screen and another screen. So Lennar called the quarter challenging. Said early in the quarter they had seen sales stall at then prices and incentives. So at the beginning of the quarter, the prices they had and the incentives they had, sales simply stalled. New orders for the quarter are down. Gross margins for the quarter are down, and they're lowering their Q1 2025 expectations. Okay, two headwinds that may be facing the housing sector in 2025. One headwind we know is going to be high interest rates, high mortgage rates. We have two others: tariffs, because there are building products that come into the U.S., primarily softwood timber, and labor. And undocumented immigrants make up a large part of the construction trade, especially in the southern states. Hard to get recent information on this, but I did find something from 2021, and I did find something from 2022. So we could sort of line these up. This is a number of undocumented workers and the share of the workforce that is undocumented for different professions within the construction industry. And I tried to line them up with this chart, which is share of immigrants in the labor force in 2022. So if we look at our first category, construction laborers, number of undocumented workers, 445,000. Keep in mind that is 3 years ago, it's 2021. Share of workforce that is undocumented, 23%. If we line it up here with construction laborers, 41%. Construction trades most reliant on immigrants, share of immigrants in labor force. 41% of the employees of construction laborers were immigrants, and 23% are undocumented. It's not that all of these are undocumented. You're going to have immigrants that are documented. They're not going anywhere. The undocumented ones, that may be where the issue is, right? 23%. For carpenters, 225,000, 19% undocumented. Here are carpenters at 33%. Painters and paper hangers. Look at that. Mostly paper hangers. This is wallpaper, but you can call them painters. 167,000. These are your three big categories. 29% undocumented, and they're over here. 48% of the labor force is made up of immigrants, with 30% of those being undocumented. So 30% of 50% is 15% of the labor force in that category. I'm not going to read them all off to you. You can see where they are. This is a headwind that's facing housing. If you start removing these people, you're going to create a labor shortage here, which will only create a bidding war between the builders to get labor, which will only raise the price of housing. And if cost is already an issue, this will get even costlier. Lennar did say tariffs and immigration will have limited effect on them. So I guess they're in a position to know how many undocumented workers they're using and how many are documented. They must be in a position to know. Although I don't know how, to be honest with you, because they don't build the house, right? They hire, this is bid out to a contractor who will build the house, and there'll be a certain price for it to be delivered, and the contractor then has the employees. I'm not sure how Lennar would have visibility in here unless it's part of the bidding process where that has to be disclosed, is what proportion of undocumented workers you have, or there can be no undocumented workers. Because I think, well, what would lead me to say tariffs and immigration would have limited effect? I must have some visibility into the contractor's side of things. So maybe it's part of the contract. I don't know. These charts come from Fannie Mae. They have their predictions up, 5 predictions for 2025. Only 3 of them really are important for what we're doing. 2 of them apply to multifamily, and I think we can ignore that. First one, average mortgage rates over 6%. I find that hard to disagree with, really. We're at 6.72. Mortgage rates have gone up. while Fed funds rate has come down, simply because of where the 10-year is. If you want the 10-year to come down, you're going to need to see progress on the deficit, clear progress, not just, I wonder what he's going to do, come January 21, but clear enough progress. After 90 days in office, first 100 days, you should have some kind of visibility on that. You're going to have to see some progress on the deficit and a resilient economy with inflation coming down. And I think you could see mortgage rates head to the 6%, maybe even lower. But, a lot of things have to come into play there. So average mortgage rates over 6%, that's average. Yeah, I can see that. Because even if rates stayed at 6.7 for the first 6 months and dropped to 5.7 for the next 6 months, your average for the year is still over 6%. Hard to disagree with that. Number 2, existing home sales stay at a 30-year low. That's hard to disagree with as well, unless you get mortgage rates below 4%. So let's have a look at this chart that they provide. This red line over here is the share of mortgages with an interest rate greater than 6%. You're sitting somewhere around 15-16%. And the blue line is the share of mortgages with an interest rate less than 4%. It was almost 70%. We're sitting just maybe 59% right now. 59% have mortgages less than 4%. Lennar pointed to this and said it is stopping the trade up, because families usually will leave one home and move up to bigger homes, but that's not happening right now because of this lock-in effect. I find it hard to disagree with this one as well. Existing home sales stay at a 30-year low. So that leads them to point number 3. New home sales will have a solid 2025. And this chart here is the median sales price for a new home is now similar to that for an existing home. And this is the premium over a new home. This is 0%, meaning that a new home per square foot, the median selling price for a new home is equal to the median selling price for an existing home. Right now, that's sitting about 4% above the median price for an existing home. However, look at the difference in size. Up here, when you have this big premium, this was the first quarter of 2015, the average new home build was 2,500 square feet. For Q3 2024, the average new home build was 2,150 square feet. So you have roughly about 350, 360 square feet less house. And that's how you're getting to this 4%. So it's, before we start thinking that, wow, new home prices are under pressure here, it's new home sizes are under pressure. They have been dropping. What does Lennar say? Demand is strong. Supply is still weak, but you have wavering consumer confidence and the elevated cost of acquisition, primarily pointing to the interest rate, because with their floor plan designs, they can build a house to a certain price, but you still have to finance that home. Considerable traffic, but a lack of urgency. I can see that. I can see during the their last quarter, the third quarter, I can see the case for that. If I'm in the market for a house, I've clearly gone to my bank. I've clearly done some kind of research on mortgages, and I'm more than likely aware that interest rates are coming down. So as I'm looking for a house, I don't feel a sense of urgency because interest rates are coming down. If I wait a couple months, interest rates may be lower. But I may be confused between interest rates and mortgage rates. Mortgage rates have gone up while interest rates have gone down. But to say that lack of urgency, you see this in Canada. Interest rates are dropping very fastly with Bank of Canada. The home inventory that's for sale is just building up. Spoke with somebody who is in the market for buying. Oh, well, with rates coming down, I'm not really in that much of a rush. I think if I wait till spring, they'll be lower. because they're looking at what will my monthly cost be, not how much am I paying for the home. And if you have financing, that's a big part of your monthly cost. So I can see the lack of urgency. They said they expect demand to reestablish. Supply remains constrained. This is something you're hearing from Fannie Mae as well, is that the lack of housing in the U.S. is still a problem, that supply is well below where it needs to be. Part of the supply being well below where it needs to be is this lock-in effect up here. Here's their forecast for new single-family home sales. This is a seasonally adjusted annual rate in thousands. The red dotted line was their prior forecast. Look at their current forecast. They expect a dip over here, and then it meets up with their prior forecast, but just doesn't hang in there. That it's less of a forecast than they had in terms of the run rate for new single-family homes. And still, even at these levels, you're still well below 19, 20, 21 levels. All in all, I think based on this lock-in, I think the home builders are looking interesting, especially having come back the way they have. Let me just refer back to some notes here. You have all the home builders, roughly 25, pushing up to 30% down from their highs. Although I will say that when I did see, DHI and Lennar sitting around 190, I thought there's not much in here to buy at these levels, at this price. You're pricing in the next few years of success all today, and that's was what market's been doing the last couple of years. Is if you have a forecast of something over the next couple of years, the market is, well, why wait? Let's price it all in today as if it's going to absolutely happen, and then we'll be disappointed when it's good stuff, but not as good, right? It was a little excessive, so we got to take the 25-30% pullback with a grain of salt, and that I think it probably went too far to begin with. I think the XHB is the right one to look at. It's down 15.71%. I think it's too early to take a full allocation, but it's certainly early enough to nibble, which I have been doing. Just grab a little bit here and there. If you think that you want a $10,000 allocation to home builders, I think now's a good time to grab maybe $2,000. And knowing that there's probably some softness in this coming up, which is what you would be hoping for. But I don't see the housing problem as being solved in the U.S. There's still a shortage of housing. So I don't see 4% mortgage rates for some time. I think that you're going to have this lock-in for quite some time. So yeah, I think it is the home builders for the next few years that will do well in this sector. And I'm of the thinking that the bigger ones tend to win. There is a return to scale in home builders. That's DHI and Lennar. And if you're uncertain, the best place to be is in a diversified ETF like the ITB or the XHB. That will do it for this week. And I think we have one more left this year. One more left. So next week I'll try to think about some themes for 2025, investment themes for 2025 that make sense.